Hi, I'm Savvy from Roots in Real Estate. Joining me is mortgage expert Elena Wolf as we break down myths, challenges, and insights to help you navigate property financing. Hi, Elena. How are you today?
Hi, everyone. I'm Elena Wolf, a senior mortgage consultant at Huspy, and I'm so happy to be here today as a guest of Rootsland. It's always great to connect with a team I've known for years and share some insights about mortgages. Thanks for having me.
Let's start with something we hear all the time. What are some of the biggest misconceptions people have about mortgages in UAE?
Interesting questions. There are quite a few, and I hear them all the time from clients. One big one is that the lowest interest rate is always the best deal. It's not just about the rate. You have to look at fees, early settlement penalties, and how flexible the terms are. Sometimes what looks cheap on paper ends up costing more in the long run. Another is the idea that a mortgage is just a financial burden. I get it, committing to a mortgage can feel heavy, but it's also a way to stop throwing money at rent and start building an asset. For many, it's more of an investment than a liability. Then there's the belief that non-residents can't get mortgages here. That's not true. Non-residents can qualify, usually with up to 60 or 65% LTV, depending on the bank. It is a niche product, so not every bank offers it, but it's definitely an option. And one I hear a lot lately is about the golden visa. Some think they cannot get it if they take a mortgage, but that's not the case. As long as the property is worth 2 million dirhams or more, ready or off plan, you can still qualify. For off plan, you usually need to pay around 10 to 50% before you can apply for the golden visa. It just shows how important it is to have the right guidance, like working with a mortgage advisor to help.
Okay, so from what you're saying, many buyers get confused between fixed rate and variable rate mortgages, right? Can you break down the differences and help us understand which option is better for a different type of buyers?
Sure. With a fixed rate mortgage, your interest rate stays the same for a set period, usually between 1 to 5 years, depending on the bank. This makes your payments predictable, so it's great for stability and planning ahead without any surprises. After that period, it usually switches to a variable rate. On the flip side, a variable rate mortgage means your interest rate changes with the market. Here in the UAE, it's tied to the IBOR, which is what banks charge each other for borrowing. Your payments could go up or down depending on market movements. If you're comfortable with that risk and think rates might drop, it could be worth considering. Now, which one is better? Well, it really depends on each person's financial situation, risk tolerance, and market trends. Recently, with the US Fed rate drop, we've seen the IBOR decrease too, and more people are asking about variable rates. But even with the drop, variable rates are still around 2% higher than the lowest fixed rate out there in the market. So rates might go down further, or they might not. It all comes down to your financial situation and what you're comfortable with.
That's very insightful. Thank you, Elena. Now, with the way that market is shifting, people are wondering, should they buy now or wait? What is your take on that?
It really comes down to your personal situation and goals. Property prices have been on the rise in recent years, driven by strong demand and economic growth. But with the recent drop in US interest rates, and since the UAE dirham is pegged to the dollar, we have seen the IBOR decrease. That's lowered borrowing costs a bit, and it could attract more buyers, which may push prices higher over time. When demand decreases, prices often follow. So if you're thinking of buying, acting sooner might be smart. But at the end of the day, it's best to assess your situation and speak with professionals before making any big moves.
The interest rates have been a really big topic of discussion. So tell me how these fluctuations affect mortgage affordability and how do buyers prepare for them?
Great question. If interest rates go up, your monthly payments will increase, meaning you can borrow less from the bank, which can put more strain on your budget. But if rates go down, your payments get lower, making the mortgage more affordable and allowing you to borrow more. Also in the UAE, when banks assesses your mortgage eligibility, they typically consider up to 50% of your income for loans or liabilities. This means they look at your monthly income and what you already owe to make sure you can handle the new payments. It's always best to check with the mortgage consultant to understand what you can actually afford, so you avoid any surprises and the risk of booking properties that may end up being out of your budget.
Okay, so let's say for someone who is buying a home for the first time, I think getting mortgage can be overwhelming sometimes. So what would you say are the key tips to make the process smoother and more beneficial?
For first-time buyers, honestly, the best thing you can do is talk to a mortgage consultant, or even a few for that matter. A good consultant, like myself, has access to multiple banks and can assess your needs, offering a tailored proposal that fits your situation. This helps secure the best rates and terms, making the whole process much easier. At the end of the day, it's about understanding your budget, planning ahead and getting the right advice so you can make confident decisions.
You know, from what I see from my experience in Rootsland real estate, that buyers choosing between off-plan properties and ready-to-move-in homes. Let's say, how does the mortgage process differ between these two?
For ready-to-move-in properties, it's pretty straightforward. Residents can get up to 80% financing and UAE nationals can go up to 85% if the property is below 5 million dirhams. There are plenty of banks offering these mortgages, so you have more flexibility in choosing the best deal. Off-plan properties, however, can be a bit more complicated. Typically, banks offer only up to 50% financing, meaning buyers need to pay the other 50% themselves first before they can avail the loan. Plus, the project needs to be at least 50% completed in order to qualify for a mortgage. To be noted that not all banks offer this type of financing, and it's usually only available for Tier 1 developers. Also, interest rates for off-plan properties may be different from those for ready homes. So, the mortgage process for off-plan properties can be more limited and have stricter requirements, whereas ready-to-move-in homes generally offer more options and flexibility for buyers.
You know, as you and myself, we're living in one of the best cities in the world, and Dubai do attract a lot of international investors. But getting mortgage as non-resident comes with its own challenges sometimes, right? What would you say are like the biggest hurdles and how can they navigate them?
Mortgages for non-residents are definitely possible. But I agree, it comes with some challenges. First thing I always say, it's crucial to work with a mortgage consultant like Huspy, who knows the ins and outs of non-resident financing options. This really makes all the difference in getting the right product and even making it happen. Some challenges non-residents may face. Not all banks will offer loans to non-residents, so their options can be limited. Interest rates tend to be higher for non-residents compared to residents. Certain nationalities can be restricted from obtaining a mortgage. Many banks offer up to 60% loan to value and sometimes up to 65%, depending on the bank. Life insurance providers may not cover some nationalities, and without this coverage, some banks won't approve the loan. I've also seen many non-residents who tried going directly to the banks or working with less experienced consultants, only to waste time and get rejected because the file didn't fit into the bank's policy. So it's really crucial to have the right mortgage advisor on your side to navigate these challenges and avoid all that hassle.
Thank you for that. That sounds great. I think I'm ready to buy a property myself right now. But you know, for the real estate investors that are looking to scale, how can they leverage the mortgages and maximize their portfolio growth?
That's a very good question. Mortgages can be a smart tool for investors to grow their real estate portfolios. Instead of tying up all their capital in a single property, they can spread it across multiple properties. By making a deposit instead of paying all cash and financing the rest, investors can potentially own multiple properties, which may benefit them through property appreciation across a larger portfolio. Rental income from these properties can also help cover mortgage payments, making the investment more manageable. However, it's important to note that for investment properties in the UAE, banks typically only finance up to 60% of the property value. This applies to both residents and non-residents. This is where a mortgage consultant like Huspy can be really valuable, helping investors understand their options, finding the right financing, and create a plan that aligns with their goals while minimizing the risk. Hold that thought, Sabine. I need to grab my jacket. Temperatures are dropping in Dubai.
You know, there is always questions circling around refinancing, and can it be a great strategy? But it's not always like it's the right move, right? What would you say are the risks and also the benefits of refinancing? And when should someone seriously consider it?
Great question. Refinancing can actually be pretty beneficial, but it depends on your situation. Here's why someone might consider it. Lower interest rates. If interest rates have dropped since you first took out the mortgage, refinancing could get you a lower rate, which means paying less each month. Better loan terms. Refinancing could give you the option to change your loan term, either extend it for lower payments or shorten it to pay off faster. Another reason may be access to equity. If your property's value has gone up, refinancing might allow you to tap into that equity. Just a note, equity is typically available for home renovations or buying another property in the UAE. And the last reason I would say, switching to a fixed rate. If you're on a variable rate and you're worried about future rate hikes, refinancing to a fixed rate could give you more stability. Huawei, refinancing can come with fees, so it's important to weigh those against the benefits. Working with the mortgage consultant like Huspy can really help figure out if refinancing makes sense for your situation.
You know, I have a question from a friend of mine that is self-employed, and some buyers often struggled with mortgage approvals. Why is that? And actually, what kind of steps can they take to make this process easier? What would you say?
It's definitely a bit trickier for self-employed residents in the UAE when it comes to getting a mortgage. Banks are usually more cautious. For instance, some banks may require their business to be established for 1 to 3 years, and they might prefer they have a physical office rather than operated from a flexi desk. They also want to see consistent income, not just seasonal, and it helps if you have multiple clients. If most of your income comes from just a few clients, that might be considered as high risk. Other things like VAT certificates, audited financial reports, and certain turnover levels may also be required, especially if you're aiming for an 80% loan as an expat. That said, the good news is there are products available, like low doc mortgages, where self-employed residents might qualify for up to 60 to 65% financing based on personal income instead of company income. Not all banks offer these, and the rates tend to be higher compared to salaried residents, but it's still an option. This is where working with an experienced mortgage consultant like Huspy really makes a difference. They can help you navigate these requirements and find the right solution for your situation.
This is such a great chat, Elena. You know, I am really curious. What is like the most challenging mortgage case you have worked on, and how did you manage to resolve it?
I really like this question because in mortgages, particularly in the UAE, there are always challenges and we're often under pressure with tight deadlines. One case that stands out was a salaried resident, a vanilla case, let's call it. Everything was going smoothly and we were about to receive the final offer letter when suddenly the bank informed us that the client had been made redundant due to the company closing its branch in Dubai. He had omitted this crucial detail, so no job, no loan, right? Even with pre-approval in place, the client still needed a current job in order to proceed. This put the client at risk of losing his 10% security check. Thankfully, we managed to extend the contract by a month using protective clauses. I then moved the mortgage to his wife's profile with him as a co-applicant, and we got the deal through despite the tight timelines. Another common challenge is when a client is selling their current property and wants to apply for a new mortgage. To secure final approval, they need to prove the first loan is cleared or the unit is sold, particularly if they want 80% financing or their affordability doesn't allow for another loan. Timing is critical here. If deadlines aren't met, they risk losing the 10% deposit and might have to move out because the new buyer has already completed their part. I was able to save the deal, and the client left a super nice review mentioning that she probably would have lost her 10% check if it weren't for me. That was really rewarding, but the stress was huge. These are just a couple of examples, but every case brings its own set of challenges, and banks have their own rules to follow as well.
You're really champ for that one, Elena. Let's move to the next question, which comes in my mind about a rejection. You know, some of the buyers get denied mortgage. Why that happens, and what can buyers do to avoid rejection from the mortgage companies?
Great question, Sabine. Even financially stable buyers can sometimes face issues with mortgage approvals. And it often comes down to factors beyond just having enough money or a solid job. For instance, if your credit score is below the bank's requirements, if you've missed payments in the past, or if you have too much existing debt, that could cause problems. Banks also consider the property's valuation. If the valuation is lower than the asking price, the bank will only finance a percentage of the lower value, meaning the buyer will have to cover the difference. Additionally, the type of property plays a role. Off-plan properties or leasehold properties, for example, aren't always financed by all banks in the UAE, as some have stricter rules about these types. So it's important to keep in mind that mortgage approvals are about more than just your income. I often compare mortgages to puzzles. First, we assess the client's situation and needs, then choose the right bank based on their unique circumstances. That's why having a knowledgeable mortgage advisor like Huspy from the beginning is essential. Each bank has its own policies and criteria, so while you may not fit one bank's profile, another could be a perfect match.
Similar to what we talked earlier, Dubai is a home for many expats looking to buy property over here. What would you say is your best advice for them who want to secure a mortgage here in Dubai?
In a nutshell, for expats looking to secure a mortgage in Dubai, they should keep in mind that a 20% down payment is required for properties below 5 million dirhams and a 30% for properties over 5 million dirhams. Additionally, around 7% should be set aside for other fees like real estate, government, and bank fees, which are separate from the deposit. Some banks may include a partial amount of these fees in the mortgage loan, but not all do. So it's best to be prepared. If the property's valuation comes in lower than the selling price, the bank will finance the loan based on the lower value, meaning a higher down payment will be needed than originally planned. It's also crucial to apply for a pre-approval before locking in any property, so you have a clear understanding of what the bank is willing to lend you. With that being said, the best thing they can do from the start is to work with a mortgage consultant like myself who can guide them through the process. That way, they avoid surprises and make sure they are fully prepared.
That's really insightful. Thank you. I'm definitely sharing that with all my friends trying to purchase property in Dubai. I have now very interesting question. If someone has unlimited income but no credit history, could they still get a mortgage? And how does that work?
Sabine, that's an interesting scenario. Having no credit history could make things a bit tricky, even with substantial income. Banks in the UAE rely on credit reports to understand someone's financial reliability, and without one, they could see the applicant as a higher risk. That said, it's not impossible. Some banks could still lend if the applicant shows financial stability in other ways, like consistent savings, strong proof of employment, or larger deposits. For example, while most experts could secure up to 80% financing on a property below 5 million, in such cases, the bank might limit the loan to 60 to 70% or adjust the terms to reduce their risk. Non-residents, however, don't need the UAE credit history to apply for a mortgage, as their requirements are different from those for residents. This is where working with a knowledgeable mortgage consultant like Huspy becomes essential. They can help identify the right banks for unique cases like these and guide clients in presenting a stronger application to improve their chances.
I know I have kept you for so long, but I do have one more question. For the buyers that are looking to purchase property, not just one, but multiple, what are the financing options and most effective for them?
Good question. For expat residents in the UAE, if the property value is up to 5 million dirhams, the first property can typically be financed up to 80%, while the second and third properties are capped at 60%. For locals, the first property can go up to 85%, with subsequent properties capped at 60%. If the property value exceeds 5 million dirhams, expats can borrow up to 70% for the first property and 60% for the second and third. For locals, it's 75% for the first property and 65% for the others. For non-residents, they can also purchase multiple properties if affordability allows, but financing is usually capped at 60%. In some cases, if they qualify for a specific 65% product for the first property, the second and third property will be capped at 60%. Another option is leveraging equity. If they already own a fully paid property, they can mortgage that property to take out equity, which can then be used to purchase another property in the UAE. Lastly, some banks offer portfolio financing, where multiple properties can be bundled into a single loan. While this option can be effective, it's more complex and comes with specific requirements. The key takeaway is to work with a knowledgeable mortgage consultant like myself to navigate these options and tailor them to your unique goals while managing risks effectively.
This has been a really insightful conversation. Thank you so much, Elena, for your expertise sharing with us here in Rootsland.
Thank you so much for having me on the podcast. It's always a pleasure to share insights and discuss the mortgage world. Working with Rootsland has been an incredible experience. I've known the team for years, and their professionalism and dedication to clients always stands out. Looking forward to more collaborations in the future.